In today's episode of the Daily Brief, I'll talk about two interesting stories. I'll first talk about India's new electricity policy trying to switch lanes, and then I'll talk about the contradictions of India's efforts to digitalize. Welcome back to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host Akshara, and today is Wednesday, 28th January. Coming to the first story. So, a lot is happening on the regulation of Indian power. Earlier this month, the government released the Draft National Electricity Policy or NEP 2026, a massive update to India's electricity blueprint since the NEP of 2021. Just before that, in December, the Draft Electricity Amendment Bill 2025 was in circulation, aiming to repair the broken state of India's state discoms, which we covered previously on the Daily Brief. Something is afoot. India wants to become a manufacturing powerhouse, but our industrial electricity tariffs have always been relatively too high. This is partly because of the choice we made as a country about who we would subsidize and who would bear the bill, but partly it's structural. Our power procurement has always been rigid, making Indian discoms financially inefficient. Meanwhile, most of our transmission planning prioritized interstate corridors while grids within states were neglected. The old model is broken. The draft NEP 2026 acknowledges that, but there are also new opportunities. Renewables like solar and wind could help usher in a new paradigm. In this episode, we'll be looking at how the 2026 NEP is trying to midwife this change. This is a strategy document, not a legal one, but it indicates the directions that our energy laws might take. Let's dive in. If you want to understand where Indian discoms bleed money, start with how they procure power. As we've explained before, power procurement makes for approximately 70% of a discom's total costs. For decades, discoms have been locked into long-term power purchase agreements or PPAs, 20 to 25-year contracts with fixed capacity charges. The discom would pay for this whether it used the power or not. Now, India has acknowledged this as a problem before. The 2021 NEP wanted to move at least 25% of all power procurement away from inflexible PPAs to spot markets by FY 2024. However, that vision didn't become reality. Only 13% of power gets transacted in spot markets even today. So, why didn't it work? For one, discoms didn't see their PPA costs change even if they procured power on the spot. But secondly, discoms didn't trust markets a lot. Spot prices for power were far more volatile than what the PPA was assured. And votes wouldn't take kindly to increases in power prices. Without a major institutional change, there was little reason for discoms to embrace electricity markets. Renewables have changed that. We're deploying solar power faster than coal, and the abundance of power offered by renewables often makes market procurement cheaper than coal-based PPAs. At the same time, market procurement alone is a bad strategy. The pricing of renewables swings wildly depending on the time of day and weather conditions. So, the draft NEP 2026 tries to split the difference. It gives discoms flexibility and it doesn't mandate any numerical targets, but it brings in new instruments that could help transition towards more market-oriented schemes. One such instrument is the Virtual Power Purchase Agreement or VPPA. Unlike a traditional PPA where a discom physically procures electricity from a coal plant, a VPPA entails no such direct supply. It's a hedging instrument between the financial consumer of power and a renewable energy generator or REG. So here's how it works. A buyer and the REG agree on a strike price of power, and then business goes on as usual. The REG sells energy to the grid at market prices while the buyer gets power from its local discom. But every month, a power exchange settles the difference between the market price and the strike price. If the former is higher, the generator pays the buyer the difference and vice versa. This can help raise the share of renewables in India's energy mix while reducing the burden of procurement on discoms and old coal plants alone. Now, the draft electricity amendment bill complements this with stricter financial discipline for discoms. For one, it mandates that discoms can't hide losses in regulatory assets that are passed to future consumers. It also gradually phases out cross subsidies for manufacturers and the railways, which have their own captive power systems. And finally, it allows private players to compete with discoms. We have gone into most of this in detail in our episode on discoms, so check that out for more detail. However, instruments can only go so far. These changes won't be enough unless India's power grid itself is modernized, and that's what the new NEP tackles next. Let's start with the current structure of the grid. So, the grid in any state is governed by two key entities: the State Transmission Utility or STU, which builds out intra-state transmission lines, decides voltage levels, sets technical standards, and so on, and the State Load Dispatch Center or SLDC, which oversees day to day operations. In practice, though, in most states, both functions are performed by the same entity. Now, this creates an incentive mismatch. The entity that decides where and how power flows also owns the grid, and so it could try to compensate for failures in one by overdoing the other. Imagine, for instance, that a state's power system faces persistent congestion. There is a way to run the grid so that it doesn't happen. Better forecasting and scheduling, tighter congestion management, smarter grid tech, and so on. But this is hard to pull off. Now, there's also an easy answer, but a bad one: overbuild the grid. The latter is wasteful, but sadly, it's also attractive. Utilities' returns are regulated. They're given a fixed rate of return on each project's cost, whether or not it needs to be made. This detracts the entity from choosing sophisticated solutions. It's just easier to reduce day to day stress by locking in firm supply through long term PPAs, often with coal plants. They're an operational shortcut. They're predictable and don't have to be managed constantly. Of course, they load the system with fixed obligations that run for decades, crowding out cleaner, more flexible options, but that's somebody else's problem. This is the very dynamic the NEP is trying to move away from. Earlier, India had recommended that states separate both these functions, but back then they were set in their ways. Separation was hard to achieve, and as long as it wasn't mandatory, nobody wanted to make a move. The latest NEP explicitly mentions that state governments should establish an independent company for day to day management. Now, this could become an unbiased grid referee. Without the option of expanding the grid, the SLDC will have to make efficient grid operation its priority. And this will also increase trust in SLDCs. Buyers and generators can expect the dispatch to behave in a way that doesn't undermine their VPPAs. So, to complement this SLDC STU split, the new NEP has made tariff based competitive bidding or TBCB the default mode for allocating all grid projects. So, in a sense, private players will be allowed to bid against public entities for projects with the lowest bid winning. This wasn't compulsory under the earlier version of the NEP. So previously, competitive bidding was allowed, but tariffs could also be set using the cost plus method, where you would be compensated for the costs you took on rather than your performance or market demand. Naturally, utilities mostly chose this, and this pushed the system towards larger, more expensive plants. If your returns were linked to the capital you put in upfront, you would want to build the most expensive possible project that could get approved. This could fix the mismatch, pushing entities to try and set up the most efficient possible projects. Third, the NEP prioritizes building intra-state lines far more than interstate lines. So, for years, India's grid planning focused on interstate corridors, which are big electrical highways that move power from coal rich states like Chhattisgarh to demand centers like Maharashtra. Now, this made sense when large centralized coal plants were the primary source of power. But as renewable generation has grown, the congestion has moved inward. Solar farms and wind installations are more decentralized and closer to load centers. But without enough infrastructure, this also creates bottlenecks. Our poorly optimized local grid can't handle the variability that comes with renewables. And so, increasingly, the worst bottlenecks occur within states. Take Tamil Nadu for instance. During surplus periods, it actively sells power to its neighbors Karnataka and Andhra Pradesh, which need it more. On aggregate, the state is often able to balance supply and demand through interstate trade. However, its own lines between renewable heavy areas like Tirunelveli and industrial hubs like Chennai aren't well developed, so power imbalances within the state are common. The big shift this NEP signals is a move towards renewables. The 2021 NEP saw coal as the backbone of the system. It was still the cheapest source of energy, and renewables then were merely a useful supplement. While the new draft continues to keep coal front and center, it's no longer always the cheapest energy source. In fact, we have excess coal capacity. Many coal plants are stranded assets which could turn into bad loans for banks. And so there's no longer a heavy focus on creating new coal capacity. So instead, the goal is to utilize the existing coal fleet better, ramping it up and down quickly to complement variable solar and wind generation. It is, in other words, just a stepping stone for the transition towards a renewable heavy economy. Now, this shift is backed by new enforcement mechanisms. State regulators must enforce targets that specify how much of a consumer's power must come from non fossil sources. Now, these targets existed before, but they were toothless. There were no penalties for not meeting them, but the recent Electricity Amendment Bill changed that. The policy is also betting heavily on decentralized energy generation. It promotes rooftop solar coupled with energy storage, aiming to turn consumers into prosumers who both consume and produce power. But there's a catch. Consumers with installations over 5 kilowatt of capacity can't avail net metering. So this means that your power bill won't be calculated net of how much power you've supplied to the grid. You must settle your exports separately. So why would a pro renewables policy discourage net metering? So, this is because net metering would let prosumers use the grid as free storage and reduce their power bills to near zero. They would export surplus solar during the day and draw power at night without paying for the grid infrastructure that makes this possible. So, the policy wants prosumers to invest in their own storage instead. There are many things in the new draft of the NEP that we couldn't cover. They include a focus on nuclear, hydropower, battery storage systems, and so on. However, at a broad level, the NEP reflects India's ambitions to shift from a non market centralized power system to a renewable heavy, market oriented grid. The seeds of this shift were laid in NEP 2021 itself. But plenty has changed in the last 5 years, and the latest NEP is doubling down on those ideas. The execution of the NEP will not be easy, however, and depends mostly on the incentive structure of various participants. The existing incentives have created inefficiencies that do not seem to fit a grid focused primarily on renewables. Success will depend on whether the energy laws inspired by the policy are able to shape those incentives for the better. Coming to the second story. So, India wants to be a manufacturing powerhouse. The 2014 Make in India campaign set an ambitious target. Manufacturing should contribute 25% of GDP by 2022. That didn't happen. The sector managed just 13% that year, around as much as it did a decade ago. Meanwhile, services keep growing, now accounting for over half the economy. This isn't a new story. India's growth trajectory has been services led for decades, a pattern economists often consider unusual for a developing country. Most countries in the world have gone from agriculture to manufacturing to services, but somehow India seems to have skipped some steps in between. So, do India's own policy choices inadvertently reinforce this pattern? A recent paper by researcher Yu Tong Chen suggests they might. Chen tries to look into whether all firms can universally take advantage of a massive digitalization push, taking India's recent efforts as the subject of her study. So, the results reveal interesting nuances about the nature of India's growth so far and what it might mean for our latest push to build factories and create industrial jobs. Let's dive in. Now, to find the answers, the paper situates itself at a crucial point of time in India's economy. On November 8, 2016, India announced that all old 500 and 1000 rupee notes, 86% of currency in circulation, would become invalid going forward. It was meant supposedly to fight corruption and tax evasion, but the immediate effect was a massive cash crunch that lasted months, devastating many small businesses. As a silver lining, demonetization kick-started the eventual explosion of digital payments in India. UPI adoption surged manifold, debit and credit card transactions grew, and mobile wallets like Paytm saw exponential growth. India's economy was going through a digital drive like no other. So Chen saw an opportunity here. The demonetization shock hit the whole country at once, but the ability to adapt to it wasn't uniform. Some areas had better digital infrastructure, more stable internet, more data centers, higher mobile penetration, and so on. Others didn't. Now, this created a natural experiment. If you compare firms in digitally ready districts to those in less ready districts, before and after November 2016, you can isolate the effect of digitalization on firm performance. So, with the help of government data, Chen created an index to check the digital readiness of various districts. The hypothesis was straightforward. Did businesses in more digitally ready districts perform relatively better after the shock, given how they could transition to digital operations more smoothly? Turns out they could. In districts with better digital infrastructure, services firms saw income rise by 1.3% and productivity jump by 8.4% relative to firms in less digitally ready areas. However, there was one very important nuance in this result. While services firms won, manufacturing firms didn't, even in the districts that were more digitally ready. Manufacturing firms in those same districts saw income fall by 2.5% and productivity drop by 8.1%. This applied to both small and large firms, and this effect was hardly temporary, persisting for a few years post demonetization. When you think about it, it feels counterintuitive. You would expect the cash crunch to hurt services firms more. These deal directly with consumers who suddenly had no cash. Manufacturing firms, especially those with business to business models, should have been more insulated. Instead, the opposite happened. Services firms in digitally ready areas adapted and thrived, while manufacturers in those same areas struggled. Why? So here's the thing, the cash crunch indeed hurt services firms which tend to have more consumer facing operations. When a shock like demonetization hits, it effectively reduces the revenue firms can earn without going digital. But here's the funny thing, that also created stronger incentives for services firms to invest in digital technology. And that's where the most important mechanism driving these stronger incentives comes into play, how India's market for digital workers functions. So, as services firms invested more capital in digitalization, they also began aggressively hiring workers with information and communications technology or ICT skills. These would be people with degrees in computer science, software engineering, or other related fields. Historically, India has always faced a chronic shortage of ICT professionals. The share of Indian employers struggling to fill ICT positions rose from 48% in 2012 to 63% in 2019 and hit 80% by 2023. Meanwhile, labor mobility across districts within India has always remained quite low. As a result, the supply of Indian ICT workers is unable to quickly respond to a sudden increase in demand for ICT talent. Meanwhile, training new ICT graduates takes 6 years. If you want someone to enter this path, you have to start at the 11th grade, having them choose science and then pursue a 4 year degree. So, with this immediate bottleneck, ICT wages in the services sector went up, way more than manufacturing. This feature of India's labor market, as Chen finds, is key to understanding the demonetization shock. Firms that could go digital quickly had an advantage. With time, this transition became harder as ICT workers increasingly became too expensive. After 2016, wages for ICT professionals rose by about 10% in more digitally ready districts compared to less ready ones. But the wages for everyone else were basically flat. More importantly, ICT workers started moving between sectors. In more digitally ready districts, workers with ICT degrees became far more likely to work in services than in manufacturing. After all, in contrast to services, ICT wages in manufacturing pretty much fell flat, even declined in certain areas. So, service firms were essentially bidding away the talent that manufacturers needed. And this in turn created a feedback loop between hiring and investment in ICT. But manufacturing firms losing ICT talent to services didn't or couldn't make similar investments. If anything, they pulled back on digital spending. So, service firms in digitally ready areas became more productive. Meanwhile, since high skill ICT workers were now too expensive, manufacturing firms had little choice but to hire more lower skilled labor, reducing their productivity. At the same time, the inequality between ICT workers and other workers also widened year after year. And this creates a troubling dynamic for India's industrial ambitions. There's a possibility that a policy that accelerates digitalization also intensifies competition for scarce ICT talent. And in that competition, services win, sometimes at the cost of manufacturing. Now, India's government has been pushing both digitalization, Digital India, UPI, Aadhaar based services, and manufacturing, Make in India, PLI schemes. But accounting for this paper's results, there may possibly be some tension between these goals. Chen's study suggests that in a country with severe skill shortages and limited labor mobility, a sudden push towards digitalization will not have evenly distributed gains. The service sector grows while manufacturing struggles. Wage inequality widens, with gains concentrating among already well paid ICT professionals. Now, none of this means digitalization is bad and shouldn't be pursued, nor does it mean that services growth and manufacturing growth do not go hand in hand. However, what Chen does emphasize is that how large scale digitalization efforts work depends on the existing infrastructure and institutions in a country. So, what would help? Chen points to a few solutions. For one, investing in digital infrastructure in less developed regions would be useful, and so would creating tax incentives for digital adoption in manufacturing. Expanding ICT training and education would help too, though the payoff takes years. The broader lesson is that India's growth model has structural features that keep reinforcing themselves. Services attract talent because they're growing, and they grow because they attract talent. Many manufacturing industries, however, haven't yet benefited from such a cycle. Breaking out of this pattern requires thinking carefully about how every major policy shock ripples through the labor market. Now, coming to the tidbits. Adani Green plans to scale BESS at Khavda to 7 plus gigawatt hours by FY27, 3.5 gigawatt hours by FY26 end, with rupees 25,000 to rupees 40,000 crore capex, using storage to mitigate grid evacuation delays and capture peak power arbitrage from co-located solar. Coming to the next tidbit. PVR Inox will sell its 93.27 stake in gourmet popcorn brand 4700BC to Marico for rupees 226.8 crore, all cash, monetizing a non-core asset to strengthen its balance sheet while Marico bolsters its premium snacking portfolio. Now coming to the final tidbit. Hindustan Copper has emerged as the preferred bidder for the Baghwari Kirkori copper block in Madhya Pradesh after offering the highest price in a forward e-auction for a composite mining license concluded on January 22nd. You can check out all the links in the description. That's all the news I have for you. Thank you so much for watching and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.